Doing taxes on your crypto gains can be a nightmare. Because of the volatility of coins, tokens, and NFTs, tracking your real-world capital gains can get messy pretty quick. And since crypto is a relatively new way of investing, many investors will try to fly under the government's radar. But I'm here to say that this isn't the smartest move. Failing to report your capital gains from crypto correctly could land you with significant fines and set you back far more money than you made in profit.
I declare bankruptcy!
But I want to make things simpler for you. This is the best guide on the internet on how to account for your crypto. Because if you get this right, you may even be able to save money on your tax obligations. Now, to start this off, I want to remind you that I'm not a financial advisor. Always consult with a professional before doing anything crazy. Now, I get asked a lot if people really need to pay taxes on their crypto trades. The short answer is yes. The IRS seems to have systems already in place to gather information from undisclosed sources about who might have earned income from investments in digital currencies. In 2019, they sent letters to 10,000 individuals letting them know, hey buddy, you may have forgotten to pay your taxes on your crypto. And they won't stop there. With taxes on crypto formalized in the Infrastructure Investment and Jobs Act, it's not going to get any more lenient. The good news is that there are just a handful of situations in which you have to include your crypto activities in your tax report, and I'm going to cover as many as I can in this video and give you a free guide as well. So to keep things simple, there are three big events that you should see as taxable. The first is selling your crypto assets within 1 year. This is because the government sees cryptocurrencies as property. Any income you make in the sale of coins or tokens is a taxable event. If you hold onto the coin for over 1 year before selling, this is considered a long-term capital gains tax. What you end up paying depends on the tax bracket that you fall under. This chart from Investopedia sums it up pretty nicely. You'll notice that if you fall under the first pillar, you'll basically not have to pay anything on capital gains. But again, that's only if you're riding your positions long-term, more than 1 year. If you're single or you're filing your taxes as an individual, you can earn up to $40,400 in gains without having to pay taxes on those gains. Also, the limit on tax-free gains goes up if you're the head of household or if you file with a spouse. So there may be some tax advantages there to getting married.
What a luxury, you know?
Now let's compare that with short-term capital gains tax using this graph from the IRS. Income on crypto trading that comes from selling your holdings that are less than 1 year old get taxed just like ordinary income. So right away looking at this, 2021 federal tax rates actually start at 10%, even if you earn just $1 this year. That's not including tax credits, of course. And note, the numbers from this chart represent your total income, not just the income you made from buying and selling crypto. If you made that same $50,000 this year with $10,000 in gains as a single filer for short-term capital gains tax, you'd pay 22% compared to 15% if that's long-term capital gains. So it pays to hold long-term if possible. Another issue comes up when you use your crypto to pay for goods and services. This is because spending an asset like Ethereum or Bitcoin works the same way tax-wise as selling that asset, unfortunately. And if you are paid in cryptocurrency as part of your income or salary, you'll be taxed on this based on the price of the crypto on the date in which you were paid. Meaning if the value goes up by the time you sell or spend, unfortunately you have to pay tax on those gains. And this is at least until more governments recognize crypto as actual federal currencies. If you were paid in crypto or use crypto to buy things, you'll want to keep track of the date, amount, and price of the cryptos when you both receive them and spend them for proper tax accounting. But don't worry, later in this video, I'll have an easier way to keep track of all of that. The next part is figuring out the taxes you'd have to pay every time you spend or sell. This is typically done with the FIFO, first in, first out method. Basically, the crypto you receive first is the first to be considered spent or sold. Now, it is possible to use LIFO, last in, first out, to save some tax, but you'll want to be careful with this and consult with an accountant if you want to take that method. Going back to being paid in crypto, if you're converting your crypto to cash on the spot, right when you get paid, then this is as straightforward as counting up the amount in US dollars and listing this in your tax report as ordinary income cash. There is no conversion, there's no capital gains on that. But if you hold your crypto any amount of time before selling it or spending it, this is when you need to report that change in the price of the asset as unfortunate capital gains. Now, the third category is exchanging your coins for other crypto. Some people, many people, mistakenly assume that swapping one crypto for another is considered a buy and therefore assume that this isn't a taxable event, just like buying Bitcoin with US dollars. But unfortunately, that is not the case. If you buy Doge with Bitcoin, you're gonna have to pay tax on your Bitcoin gains. I know. It's unfortunate. Remember that crypto is not yet considered a currency by the US government or most governments, so they don't see this as a regular buy. They see this as trading one property for another. So let's do an example here. To help guide us, I've created a crypto gains and profit calculator. Did I spend literally 15 hours making this calculator work properly because I thought it would be a good idea for the video? Unfortunately, yes. Do you get it for free without even giving me your email address? Also, yes. All I ask is for a subscribe and watch through to the end of this video. To the example, you bought $1,000 in ADA in October. A month later, you decide that you really want to buy a Solana Piranha NFT. Who can blame you? So you go to the pre-launch sale and find out that one NFT costs 1.5 SOL. To buy this, you're going to go ahead and just exchange all of that ADA for SOL. And this is your first taxable event. Your ADA has gone up from $2.05 when you bought it to $2.30. According to our calculator, you have a realized gain of $121.95. That's the gain that you would have to pay tax on. And this is because in the eyes of our tax overlords, you have sold your ADA and bought SOL. You need to pay your tax. Now, here's the crazy part. You're going to have to repeat that process again when you exchange your Solana for your fancy new Piranha NFT. If your Solana goes up in value significantly, you should probably track this. However, to be honest, you shouldn't consider it the end of the world if your position shifts a few cents between that exchange and buying the NFT. Of course, none of that is financial advice. Now, the NFT itself also counts as property, but as long as you don't sell it within 1 year, you don't have to count that appreciation as ordinary income. Now, something else that is taxable but free money is using that link in the description for BlockFi. With BlockFi, you can earn interest on your cryptos and get up to $250 in free Bitcoin by making an account, but remember to pay your taxes. Now, what about losses? If you go through with any of these activities and you find that upon some kind of sale or exchange of your asset, you've incurred a loss in the value of your crypto, this counts as a capital loss. And it's important to report your losses as well because you can actually use this to offset your taxable income. Here's an example. You bought a stock and it increased in value by $500. Congratulations. We'll say it's taxed at 10% or $50 in total tax within the year. But you also bought and closed a position on a crypto in the same year that lost $50. You could write off that $50 tax by filing the loss alongside your stock portfolio gains. Based on IRS guidance, you can actually write off up to $3,000 in capital losses if you're filing as an individual. This can be strategic for you. It means that you could technically call your first $3,000 in YOLOs per year a tax write-off. Not financial advice. So we've so far covered the basics. These three examples of taxable events just about summarize how the IRS currently views some common transactions in crypto. But there's still some questions that the government hasn't answered. For example, in DeFi, activities like staking and yield farming tend to vary in their mechanics based on the dApp that you use. This makes it hard to pin down if your earnings should be taxed like ordinary income, capital gains, or non-taxable exchanges of assets. Now, let's break this down. Your earnings in DeFi are considered ordinary income when you decide to use your tokens in order to receive more tokens. So take an example of staking Cardano to earn more ADA in exchange for validating transactions. Because you receive more ADA for doing this, it works just like our previous example of getting paid a salary in Bitcoin. The same applies for mining on a proof of work blockchain. This is all ordinary income. Also, if you do have Cardano, you should consider staking it in my stake pool, ticker symbol MAX1. You'll earn around 5% interest annually on your ADA, and 5% of the revenue that we make goes to the Organization for Autism Research. So it's a pretty cool pool. But it gets a little tricky when you instead lend your crypto to a lending platform like Aave or Compound. These platforms have an additional layer of complexity because of liquidity pool tokens or LPTs. When you lend ETH on Compound to contribute to their liquidity pool, you get a CETH in exchange, a sort of receipt for the amount that you invested. The thing here is the IRS has not yet decided whether that counts as an exchange, and therefore we don't know whether that's a taxable event. Breaking this down, your CETH token may increase in value over time, and if and when you decide to take your share of ETH out of the pool, this then becomes a capital gain. You need to account for both the price changes in ETH itself and the increase to your ETH stockpile through lending it because you get paid back in ETH. And then you need to indicate in your filing if your profit or loss is short-term or long-term, because that affects how your income is taxed. If you held your CETH for more than a year, it could be considered under that 0% tax bracket of capital gains, so long as you don't hit the other income limits. Also a note here, for regular crypto lending like stablecoin lending, this is considered ordinary income on your taxes, which is a little bit more simple to calculate. Now, that was one example. Other DeFi platforms may have different mechanics on how they work, different kinds of tokens and different rules about when you can enter or exit a liquidity pool. It's important to understand this before you go into yield farming or liquidity staking, because it can affect your taxes. Some traders trade across several exchanges within a day, sometimes facilitated by bots. Typically, bots are used either for arbitrage opportunities or automated trading in crypto. This is where there's a bit of a gray area. I've yet to find anything explicitly in writing how this is taxed. However, it's safe to assume the worst here and consider that these gains are short-term capital gains because the trades happen on a daily basis, so that would make the most sense. Now, if you're a professional trader, you may be able to write off some of your incurred taxes by citing business expenses in your tax return. You can cite utility expenses and basically any other reasonable expense that's necessary to run your business. Deduct those expenses from your total crypto income pre-tax, and then you only get taxed on the remaining profit. It's a business. So if a large chunk of your time is going into regular trading activities, I would recommend looking at registering yourself as a business, but make sure you consult with a tax professional, because this is only going to work for full-time people who are willing to pay extra in accounting, and make sure that this is done correctly. Just make sure you do it correctly if that's an option for you. Also, if you happen to be someone who is worried about your crypto tax bill, I recommend either tracking things manually, just to get your mind off this. Use that free resource in the description if you want, or you can use an integrated accounting app like Token Tax or Coin Tracker. These services range in price depending on the number of transactions that you make per year, but it typically costs you less than about $10 a month. And another thing that you can get a ton of value for only $10 a month is my Patreon. There you'll find additional content, my buy and sell alerts that are up more than $100,000 this year, a private investor community, coaching, and a whole lot more. I look forward to seeing you over there. So I'd like to thank you so much for watching, and I hope you have a profitable day.